Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Jeffrey Christian. Jeff is a managing partner and founder of CPM Group, which is one of the most respected precious metals and commodities research companies in the world. It was founded in 1986. He knows a lot about precious metals and is well known for his financial engineering work using commodities derivatives, both for hedging and for investment purposes. He's worked with governments, the UN, World Bank, International Finance Corporation, International Monetary Fund, IMF, and many of the world's largest and most prominent mining companies, industrial companies, investment banks, and institutional investors. Okay, you're convinced that he knows his stuff. In this conversation, we cover all things gold, macroeconomic backdrop and why it's important for gold investors, drivers for gold's price, USD as a global reserve currency, and possible bearish scenarios for the gold outlook over the next 10 years. We even discuss Bitcoin a bit as a higher beta speculative play on the gold narrative and some of the issues with looking at it like that. There's a lot here and you won't want to miss it. Before we jump into the episode, I wanted to take a second to thank you for all the great questions and feedback I've been getting. You guys really rock. If you're getting some value from this podcast, please drop me a line or give me a review. These things really help, and I appreciate it. Okay, let's kick this thing off. Jeffrey Christian on precious metals. Jeffrey, welcome to the show. Excited to have you on today.
Thanks for having me here, Ben.
Absolutely. We're on the other sides of North America right now. Before we jump into all things precious metals and economic outlook, I wanted to start off with your background and what you're doing now.
Well, I started off, in university, I studied journalism and international economics. And the international economics was in the political science department. I was interested in how communist countries traded, thus the Soviet era poster behind me. That's from 1975, 76. And I was interested in how what we called back then transnational corporations interacted with developing countries. A lot of that work with China and Russia, the Soviet Union back then, and developing countries was raw materials, natural resources, commodities. So I did a lot of work in oil and gas as well as aluminum and precious metals and such like that. Got out of school, moved to New York, and was a business journalist. I actually wrote a book and a newsletter on electric vehicles in the 1970s. The gist of the book was that these things are decades away because the battery technology is not here. So I'm getting into metals. And I pivoted into metals research, base metals as well as uranium, which I had studied under energy, and precious metals. And after a while, I got tired of being a journalist, and I went to J. Aron, which was an independent commodities trading company, one of the top 12 precious metals companies in the world, the largest coffee producer. And I started running their commodities research group. It was very unique in that they had a commodities research group that did fundamental research. Most people don't have that, and actually, at the time, they were one of two companies that did fundamental research on gold, two on silver, and no one did platinum group metals until I started it at J. Aron. We merged into Goldman Sachs in 1981. In 1986, I could see that Goldman was sort of arguing among itself about the wisdom of staying in metals. So I offered to spin out the commodities research group that I was running, set up CPM Group as an independent commodities research and consulting company, and they could buy as much research and consulting time as they wanted. So they outsourced their commodities research for a few years to CPM Group until they got into a hissy fit. So for what's that, 34 years now, going on 35 years, we've been an independent research company that specializes in precious metals and financial engineering of commodities for producers, consumers, intermediaries, and institutional investors ranging from family offices to pension funds.
Before we started recording, you mentioned that you had a debate in the 80s, and the guy said that Jeff was not good at predicting gold prices. You were good at predicting economic cycles. So I think with commodities and precious metals, I'd like to start there, the economic backdrop of where we are, because I think that will be a good lead in to when we get into gold and other precious metals.
It absolutely does. And it wasn't actually a debate. It was just some journalist asked this guy and he criticized.
Oh, sorry.
But if you look at gold and you study it analytically and you think critically about it and you do econometric modeling and studies, as we've done since the late 70s, early 80s, what you find is that the primary factor driving gold prices is investment demand. And investment demand is driven by a variety of factors, almost all of which are not gold fundamentals, but rather macroeconomic and political trends. So when you start saying, well, where's the price of gold going to go? Yeah, you need to look at mine production and secondary supply and fabrication demand and central bank activity. But the key is what's happening to the drivers of investment demand. So we've spent a lot of time on the stock market, the bond market, currency markets, overall economic conditions. And we have a really good track record of calling that as well as calling metals markets. And if you look at some of our ersatz competitors, they generally speaking don't have that macroeconomic background. And they have a very superficial view of the world economy, as do most people. I mean, if you just read the internet, you see that. So I think one of our strengths has always been that we pay a lot of attention to the global economic and financial markets, and that really has a heavy flavor in our model. If you look at the econometric models that we built for gold pricing, the bulk of the independent variables are macroeconomic.
Yeah, that makes a lot of sense. And the reason why people have such difficulty comprehending this is because there's so many moving parts, and it's not just perhaps you've captured it in your models, but with a number of these variables, but there's quite a bit of them, and some are contradictory and some are moving all over the place. So it's certainly a lot of noise. And on that topic, I mean, there is a lot going on right now. This is being recorded in January 2021. But where do you see, like, let's talk outlook for the precious metals market, knowing that investment demand is driving a lot of this, and then obviously we'll talk about the supply aspect. But what's the outlook for these precious metals right now?
Well, we've seen an incredible 2020 with gold and silver prices rising sharply, and a lot of other things going on. And our expectation is that 2021, 2020 will be a period of economic base building. We don't necessarily see a very strong recovery. We don't necessarily see a major move up or down in the US dollar. We think there are clearly pressures on US Treasury interest rates, but by the same time, the Fed will work very hard to keep interest rates down in order to help stimulate and foster an economic recovery. So our expectation has been for some time and continues to be that 2021, 2022 will see rising gold and silver prices, but much more moderate over the next couple of years than they have been. Longer term, we look at this plethora of economic and political problems that the world is facing. We look at the enormous amount of sovereign debt that the United States and other governments have taken on and will take on in 2021 and probably into the foreseeable future. And we think that there will be a major economic and financial spasm at some point. It will start in some obscure corner of the debt market. In 2007, it was the collateralized mortgage obligations. Last year, it was, I can't remember what it was last year, but it was quite clear that it was esoteric. One of the things
market,
that
I think.
Huh?
The repo market.
The repo market was part of it. And again, these are areas that people just don't understand, really. They've only paid superficial attention to it. If you're in the financial markets, it's over there, but you've never stopped to really study it and analyze it. One of the things that we're looking at is the balance between underlying equities about $100 trillion in underlying equities and equity derivatives, which are in the quadrillions of dollars. And there's famous bankers will say, well, that all nets out. Well, it only nets out if it nets out simultaneously, and it does not net out simultaneously. If one company goes bankrupt somewhere in that daisy chain, you got problems. So we think that there will be major economic and financial spasms, possibly in the middle of the decade, and that could cause investors to jump back into gold and silver, and the prices go to record prices significantly higher than the record prices that we saw in gold last year and that we saw in silver in 2011, 2012.
Yeah, that makes a lot of sense. And then the outlook for something like silver is a higher beta version of that, or also the industrial applications. How does your outlook look for something like silver?
Silver, yeah, like I said, we expect silver prices to outperform, partly because they've underperformed. It's a far less liquid market than gold. There are fewer participants. It's less geographically dispersed than gold investment demand. It's a much smaller market in terms of the value. It's probably 1/10 of the value of the gold market. So that you see a much less liquid market. And when the prices start rising, silver will outpace gold. And when the prices are falling, as they were from 2013 till a couple of years ago, silver will outpace gold on the downside.
Yeah, that makes a lot of sense. I'd be curious your take on why. I mean, precious metals, gold and silver, are under owned in asset allocations across the world, right?
Right.
Well, I mean, and partially this is driven by the inflated asset prices of the other assets within that portfolio. But I'd be curious why you think investors aren't really viewing gold as an integral part of their asset allocation. Is it because we've been living in this all asset prices going up and it's just a relative game? Or I'd be curious to hear your thoughts on that.
I think there are several factors. One is the tremendous rise in equities in a largely non-volatile fashion for the last 10 years. I mean, we had a couple spasms last year and a couple of years earlier, and you had a spasm in 2015 in China. But if you look at the S&P and the Dow Jones from 2010, these things have been rising very steadily with extremely low volatility. So it's an easy do. I think that's one of the factors. Another thing is that the financial intermediaries, the market makers and the banks and dealers, find it much more easy to sell and market and trade stocks and bonds and currencies than commodities. So commodities tend to get underlooked. So the third thing is that commodities, including gold and silver, have a fundamental underlying part that most people, including the banks and dealers, do not understand. And as you know, when I was at Goldman Sachs, we had a partner who we were creating J. Aron Petroleum, and they made a pitch to the executive committee to trade some oil and gas based on a proprietary fundamental model that we would build and run. And the partner in charge of commodities and currencies shot down the proposal and said, no, if my traders have to stop and think about a trade before they make it, they shouldn't make that trade. Because he came out of bonds and he was all arbitrage. And as we were leaving, the head of J. Aron Petroleum turned to me and said, "Where are you going?" Because it was like clear. This is another Goldman anecdote. After I left Goldman, I used to go to these Christmas parties with ex-Goldman people, and I sat down, got late. I always get there late. Got there late one year. The last year they invited me, and someone said, "How you doing, Jeff?" And I said, "Good." And I've been thinking, Goldman was the least intellectually challenging place I ever worked. And an economist who had worked at Goldman with me said, "That's not fair, Jeff. It's an investment bank." So you have a financial system that's not geared up to deal with complex things that involve fundamentals. And when you start saying, well, you have to pay attention to secondary recovery, these guys say, no, I don't, because I'm going to trade stocks and bonds, you know. So I think that's another thing. I think another big factor is that because those guys don't want to trade these things, they don't market them. And that fills a space because commodities, especially gold and silver, are largely unregulated compared to other financial assets. That fills a space with people who are not regulated, who are not haven't passed a test that shows that they have any financial sensibility. Clearly didn't even take banking 101, money and banking 101 in college because they have no concept of money and banking. And they say a lot of terrible things that are fundamentally and obviously wrong. They're ignorant of the facts, they lack critical thinking, and they have these belief systems. You know, they act on beliefs. And so, you know, it's funny because you catch yourself and say, no, you don't think that, you believe it. You know, if you thought, you wouldn't believe that, but you're not a thinker, you're a believer. And that turns off a lot of investors. I mean, it's not uncommon for us to have wealthy individuals or family offices come to us and ask us to help them build exposure to gold and silver. And we should talk about the allocations in a second. And they're very apologetic, and they want us to know they're not crazies. You know, and they're coming to us exactly because we're not crazy. Yeah. A third Goldman anecdote. The day that Goldman announced it was buying J. Aron, I became a Goldman employee, and I was sent over to have lunch with Leon Kuberman, who was the head of investment research, and Gary Wenglowski, who was the chief economist. And I was going to be reporting to them. And as I was, and I was a young kid, I didn't know who these guys were. As I was shaking hands with Leon, he said, I want you to know, I think gold is a religion, not an investment. And I was the most vociferous opponent to buying J. Aron on the executive committee. And because I was naive, I said, you know, well, sir, I agree with you that for most people, gold is a religion, but we've done a tremendous amount of quantitative research. And I think that you will be impressed to see that you can invest in gold on a quantitative analytical basis, even though it's crowded with religious believers. And Leon said, no, I won't be. Yeah, but I think that the presence of all this nonsense in the gold and silver markets turns off a lot of people. I know that because I have, as I said, I have investors coming to me and they say, you know, well, we looked at a report that you did. This goes to the allocation thing. You know, the optimal diversified portfolio, 1968 to 2020, had 25-30% of its assets in gold. You know, on a global basis, private financial wealth has less than 1%, about 0.5% in gold. Right? So you find these people, they say, well, I heard your speech, or I saw your report, or I bought your gold yearbook, and you know, I saw that efficient horizon chart, and I think, okay, I'm scared about the world too. I want to have my portfolio and my wealth diversified. I should have some gold, if not gold and silver, in my portfolio. Let's use CPM Group to build it. And the first thing they want to do is they want to explain to us that they're not part of the fringe. Yeah.
Oh, I love it. I mean, the believing versus thinking, but a thought on that is that, I mean, ultimately the argument with the gold as a religion is money's kind of a religion as well in a way. So, I mean, it is what it is. It kind of fits into that overall picture. And it's an interesting concept on the lack of licensing. And, you know, you don't have to have your Series 7 or whatever to sell gold.
Yeah.
And I did a beach workout on Sunday and I met a gold and silver salesman. It's like, you know, he's like, we go around and say a little intro afterwards. Come talk to me if you want to, you know, hedge your portfolio and buy gold and silver. It's like, well, yeah, you know, I mean, I'd be curious. Hey, it is what it is. But so I think those are all very valid points. And you mentioned a bit about portfolio allocation. When talking to the average investor, you know, less than 1%, I mean, is there? It's very tough to give these broad brush assumptions, but like if people are worried about the economy and they'd like some gold and silver, I mean, 5-10%, is this adequate? Again, very hard to give broad brush advice, but I'd be curious in kind of what kind of ranges you're talking to people about.
Yeah, well, we took the Ibbotson model. Ibbotson built a model and looked at the efficient horizon in the early 1980s and said, oh, 5 to 10% of your portfolio should be in gold. And no one updated it until we did around 2015, 2016, 2017. And we found that, when you added all those extra years, he went from 68 to 80, because that's the data that you had on the free gold price. We went from 68 to 2017 and now 2020. And when you add all that ensuing years and volatility, you see that it's 25, 30%. We never really recommended that much of your portfolio in gold until we did that research. Now we realize that probably does make sense. But yeah, it depends on the individual investor. One of the problems is that an ounce of gold is $1,840, and something like 80% of American households can't afford an ounce of gold, right? Because they need that money for food or gasoline or rent. So that really turns off smaller investors in the United States, Europe, Japan. In other countries like Malaysia, Southeast Asia, South Asia, China, you'll find that they have these little 1-gram wafers, and people will you have a much higher incidence of gold ownership. But the reality is that you should have some gold and probably some silver in your portfolio, and it depends on who you are, how much you can afford. And if it's 1 ounce of gold, but that's like 40% of your savings, that might be okay. I don't advise people to buy less than an ounce because the premiums are just so high. And then, there's silver, which is cheaper per unit.
Gotcha.
So you can do that too.
And you always advise physical ownership as opposed to exposure through, paper gold, an ETF sort of thing. I mean, always is a very strict word, I get, but you recommend.
What we do is, our view is that you should have a diversified portfolio of gold assets. So you should have some physical gold or silver, which is an insurance policy. It's a wealth protection. It's a portfolio protection and diversifier. It's a diversifier of the denominator of your wealth. It's a diversifier of the numerator of your wealth. And it has a lot of values. But that if you have the financial wherewithal and sophistication, you have your physical gold as a long-term insurance policy and investment. But then you can also have futures, options, ETFs, equities, mining equities, as things that you trade back and forth on a more opportunistic basis.
Gotcha. That makes sense. So your strategic allocation, sitting in physical somewhere very safe, and then tactical moves in and out on these more liquid instruments. So talking about the more liquid instruments, I've done podcasts on miners and silver and things, but more on paper gold. I've heard you debate this topic before, but even further up with just gold prices in general. One thing that I've heard when I've talked to people about investing is gold is they say, oh, the price of gold is manipulated. And of course, it's like we were talking about earlier, it's a belief. It's not really, they're not thinking through this or analyzing the data. But what is your response to somebody saying that the price of gold is manipulated by the big banks and the central governments? What do you say to that?
There's no basis for it. If you look at, it was very funny because in 2009, I actually have a very good friend in California who I met because she sent me an email and she said, GATA is sending this notice around that they're going to challenge you to a debate. And I said, who are you? And we became good friends. They never actually challenged me.
And GATA is Gold Antitrust Action Committee, right? So just for people to know. I had to look that one up.
They sent this note around saying, we're going to challenge Jeff Christian. Here are the 6 things we want him to refute. And so send us money so we can prepare for this. Well, they never did. And Bernard Loeb, who was anchor at Bloomberg TV at the time, said, "We'll host a debate," and they they never did it. But then the following year, they were causing a lot of problems for banks and brokerage houses and depositories. They were paying people, or not they weren't paying people, but people who paid them and supported them were paying other people to go around saying, "Oh, I went to see my gold at Scotia Bank and there was no gold at the bank," which is nonsense stuff. They brought out this guy who was actually a car leasing agent, but he was a fabulist, like Walter Mitty. And he said that he had worked at J. Aaron and he knew how the conspiracy worked. And they grabbed him. They didn't check him out to see that, in fact, he never actually had been a trader at a bank. He was a car leasing agent who probably leased cars to some guys who had made a lot of money trading gold. And they put him out there as a person and stuff. So a number of groups came to us and said, debate these guys. So we put together first audio debate in 2010, and then a video debate that Kitco broadcast in 2011. And they started both times. They said, well, here are the 6 things you wanted CPM Group to refute. Let Jeff respond. And I refuted him. You look at their evidence and it doesn't hold up to intellectual scrutiny on even the most basic level. Then you look at evidence in the market and you can say, okay, I can see that there are guys who manipulate around the market. They do spoof trading and things like that. But there's no conspiracy, no grand conspiracy, no small conspiracy. It's traders. And you see that kind of spoof trading in every market in the world. Yeah, you see that in the vegetable market in Morocco. Yeah. So you don't see any evidence supporting that. You see a lot of evidence that doesn't support it, that you can knock it down. And then you stop and say, well, wait a second, it doesn't make sense for these guys to want to manipulate the price. Yeah. So they actually have greater value in higher prices. Yeah. There was a group in Canada that was trying to promote its own silver ETF, and it was charging people a 25% premium over bullion prices and getting them to buy it, because their thing was, you can't trust HSBC and Scotia, but you can trust us because we're like a basement boiler room operation in Canada, and so give us your silver. Yeah, and it was just incredible. And then they start this thing that said, bankrupt J.P. Morgan, buy silver and drive the price up. Now, if you think about how a bank trades, banks make money at the margins. It's like, I'm going to take 5 basis points for every check you write. And if I'm a bank and I'm leasing, if I'm a bank and I'm involved in bullion, my major business is leasing metal out. I lease metal out to producers while it's being processed before it's sold. I lease metal to smelters and refiners. I lease metal to fabricators, semi-fabricators, jewelers, electronics companies. So my major business is leasing metal to the industry. For me to lease metal, I buy it and then I lease it, and then I charge a lease rate. Yeah, let's say I charge 3% for gold. Well, that's really expensive, but there's a lot of costs to leasing out to these smaller jewelers and such. And bear with me, it's a little bit long, but you really have to understand this. So let's say I lease gold at 3% and the price is $600 an ounce. I'm making 3% on 600. Now investors come in and drive it to 1,200. I'm leasing it for 3% and it's 3% of 1,200. Now it's 1,800. Yeah. So when they said, let's bankrupt JP Morgan, and the price of silver actually got up to about $50 about that time, JP Morgan reported its greatest ever gold and silver profits that year because it was charging 3% on $40 silver instead of $15 silver the year before. And these guys, it's like debating so many other things that, Eric Hoffer, who coined the term true believer, said, you cannot convince a true believer that his beliefs are wrong based on evidence and fact and observable reality, because that's heresy. So you don't waste your time with those people. But just taking a bathroom break and thinking, or reading a book on money and banking, or asking a professor at a coffee shop, you say, oh wow, okay, I just totally don't understand it. Now some of the guys do understand it, but they're in this cottage industry of marketing conspiracy, or marketing precious metals based on conspiracy, or marketing bullets based on conspiracy. Yeah.
Well, you look at their incentives, right, and figure out why they're touting these. Sorry,
Right.
continue.
Well, we break it into three groups. There's the guys who this is their business, and you're never going to get them to stop until they get busted for lying to their clients. And I don't think that that's a crime in most parts of the world, except maybe China. Um, then there are the true believers who you can't believe. You want me to convince you that there's no gold conspiracy? Let's get you a good psychiatrist, because what your belief system is based on has nothing to do with the gold market or the global economy or any deep state people that don't really exist. It has everything to do with something in your amygdala. We have to work on that. And then there are a lot of people who are educable, as I said in an interview a couple of weeks ago, and they look at the world and they say, well, there's some stuff that's kind of crazy. All this money that's going out in the Fed, and yet it's not going down to consumers and small businesses. It's going into the stock market. And it's like, well, why? And people say, well, okay, I don't understand. You have negative interest rates in many parts of the industrialized world now. Why would anybody pay a bank 25 bips to hold their money? Okay, well, first off, the government gave them that money. So 25 bips is kind of cheap. The second thing is you've got it in your reserves and you can use it as collateral for a 6% or 12% return collateralized debt obligation. So if you look at it and say, well, these banks are in tight waters and the monetary authorities are giving them all this money and they're reporting record profits, and they're reporting record profits with a record amount of assets, dollars, in the bank. They're not lending that money out. I mean, banks since 2008 have had trillions of dollars of excess reserves, whereas for all of the history of the republic up until 2008, they never had excess reserves. If you were a bank and you had excess reserves at 4 o'clock in the afternoon, you found someone to loan it to by 5 o'clock. It's just the way it was. And if you understand that, then you can start understanding banking and you can start understanding how it is that this is going on. But there are a lot of people who look at it and say, okay, there's some great crazy things going on. And you take a kernel of truth about these things, and then you wrap it around a bunch of caramel. And most conspiracies have some kernel of truth at their basis. So somebody can say, yeah, I don't quite understand what's going on with money. I don't understand why the economy is as bad it is. I don't understand why that guy can afford $100 million house in Malibu and I can't. So there are a lot of people who look at the world and say, I just don't quite understand this. And then some guy in a zoot suit comes along and says, well, it's because there's a conspiracy. Well, let me tell you how it works. And rather than find a college professor who could teach you about money and banking, you listen to the guy in the zoot suit.
People want easy answers to hard questions, myself included, everybody, right? It's like you don't want to do this second level thinking and understand the whole global economy and the banking system and how fiat currency was created and how the Fed works, all of these necessary fundamental building blocks to understand, okay, print money, asset prices go up, there's a lot more than just that. But I think that's helpful because this, I also think, is a bit of a headwind when people say, they come up with all of their own excuses for why they don't want to invest in gold. And because the price is manipulated, it is another one that seems to come up a lot. So talking about the economic world that we live in, I mean, it seems like all roads lead to some sort of massive change at some point, and gold having more value. It's not a matter of if, it's a matter of when. So if not in the next 5 years, in the next 10 years, I would think that this gold, precious metals in general, real assets would have a significantly higher value. What scenario would, firstly, do you share that opinion? And secondly, what scenario, what actions would change your mind about that sort of thesis?
Yeah. Um, I share it with some provisos. Yeah, our view is that we would not be surprised to see the gold price average around $2,800 an ounce some year. Now, the last time in 2011, 2012, the price got up to $1,800, $1,900, and the average was something like $1,620, right? So if we're saying that we're looking at an average price of 2,800, we're looking at prices close to $3,000 at some point. And there are various economic scenarios that we're looking at. The proviso is that we feel very uncomfortable with the crowd that we're in, because a lot of these guys have been saying this can't last since at least the 1970s, 1980s, and they've been wrong. Yeah. And the reality is that monetary policy and fiscal policy and the whole mashugala of international economics have changed dramatically, and this can go on for a long period of time. And the guys who are saying, oh my God, look at all this money creation, this can't last, this has got to end in fire. They've been saying that since at least the Carter administration, and some of them were saying it like in the 50s and 60s. And back in the 50s,
they might be right on a long enough time frame, right?
Yeah.
They just got the time frame wrong.
It's funny because we have clients who are coin dealers and wholesalers and retailers, and they say, get this letter from a client, and they say, I get my children say, Dad, you've been listening to so and so for 40 years, and you've been squandering our inheritance. You have to stop listening to it, because you've missed the two biggest bull markets in stocks and the two biggest bond market rallies in history. And you buy gold, and you bought physical gold and you put it in a vault, and it's now worth twice as much on a real inflation adjusted basis as it was when you bought it 50 years ago. Dad, please stop. So I have reservations, because on the one hand, things can go on obviously for a lot longer than many people believe. They already have, and they could go on further. And I can draw a very interesting scenario in which the dollar not only does not disappear or fall apart, but actually recovers all of its former glory and strength as an international currency reserve. I can easily draw that picture economically. What's lacking is the political will to do the things that need to be done.
I'd love to go down that path after this, by the way. That would be a very fascinating, and contrary to a lot of other people on this podcast, their opinion, so definitely want to tease that one out.
People will say, God, you're always so bullish on the dollars. And no, I'm just less bearish on the dollar than I am on every other currency, because the dollars are reciprocal. And the dollar has some exorbitant privilege, and 75% of private wealth in the world is denominated in dollars, and 62% of central bank foreign exchange reserves are dollars. And if you owe the world enough, you own it. So the dollar has a tremendous momentum. And you got to think about current account and the balance. And on the balance, the dollar still has this tremendous power. The problem is that on a current account basis, we're really trashing it. But that current account can be turned around. As Clinton proved for 4 years when he paid down $1 trillion of debt. He ran $1 trillion of surpluses over 4 years and paid down $1 trillion of debt in the last 4 budgets that he ran. So it could be done, but the political will's not there. At least it hasn't been up until now.
Yeah, and the numbers are just getting so astounding, right? I mean, we're going to create another couple $1 trillion of debt in this quarter alone. And, it seems like the perpetual motion machine that you just can't stop at this point. And I get the 75% of private wealth, 62% of foreign bank reserves. But it appears that this is shifting. You get these clickbait articles about Russia storing more in euros now and more in gold and their reserves. But yeah, I mean, that's a very interesting viewpoint.
Yeah, it is. Well, yeah, I mean, Russia, again, я говорит по-русски.
I don't know what that means, but I like it.
I speak Russian. I was in Brussels, 2010, and I was put up in a apartment building by my hosts, and I went to this local restaurant, and as I was walking in, this guy said something rude to me, thinking that I was an American. And I sat down at a table, and he came in. He had been outside smoking with his friends, and he came over to the table, and he leaned over, and he said something in some language. No idea which language it was, but you could tell from the way he said it that he was trying to pick a fight with me. And I stood up, and in Russian, I said to him, "Do you speak Russian?" "No, that's a pity, because now you won't know why I'm beating you." And
awesome.
He had no idea what I was saying, but he knew I was speaking Russian. And the look on his face when he said, "Oh shit, I picked on a Russian, not an American." His friends grabbed him and ran out of the restaurant. No one, the saying that we have is, no one looks to Russia as a role model, except maybe Donald Trump. China's the role model. Russia has been buying a lot of gold. It's got sanctions. Most of their foreign exchange earnings are energy, gold, oil and gas. They with the prices having been higher prior to April, they had a lot of money coming in. They wanted to sterilize it away from the dollar and euro. They bought gold. China and their gold reserves as a percentage of their total reserves rose sharply because their foreign exchange reserves were falling as they were buying gold. So they now have, 20% of their reserves or so in gold. China has bought probably even more gold over the last decade, and their reserves of gold as a percentage of their their monetary reserves has probably gone from like 1% to 1.8%, because they have this massive economic machine, and they're continuing to bring in foreign exchange reserves, and they don't necessarily sell their base to buy gold. They're taking their current flow, their current account inflow of dollars, and buying gold. So I think China is a better example of where it's going. But yeah, we've definitely done a tremendous amount of damage to the dollar, and it is repairable. Clinton showed that it was repairable, and I remember in the 90s, the People's Bank of China economists saying, we got to do what you guys are doing, which is to be self-sufficient. In terms of the fear of large numbers, yeah, these are enormous numbers. But one of the reasons why so many people hold dollars, and one of the reasons why the dollar has held up so well, is because the U.S. economy is so incredible compared to everybody else's economy. I mean, we have natural resources, we have land resources, we have agricultural resources, we have employment. People want to come here to work. They want to come to Europe to get to here. No, they want to go to Europe because they got to get out of North Africa or the Middle East because they're being slaughtered. They want to come here because they want to work. And we have we used to have 8 or 9 of the top 10 universities, and people from around the world wanted to come and study at the United States. Now we have probably about 6 of the top 10 universities. We still have a tremendous amount of installed capacity across all of those different assets, and we still have a potential for attraction. But in the last 4 years, 8 years, 20 years, we've really done a tremendous amount of disservice in damaging our reputation and telling these people, "Oh yeah, I know that we have great universities and 80% of our graduate students are foreigners, but you can't come here anymore." It's just really stupid behavior, and you have to say, "Well, gee, are you following the Russian model? Are we all going to be eating onions and cabbages soon?" because that's where that's where this leads.
Yeah, well, I mean, it's hard not to say this time it's different because it certainly feels so different with MMT talks and all of these new ways of thinking about this. It's just it's hard for me to look at parallels in history and reapply those to what's happening now because it does feel like we're in this brave new world of theoretical testing, and these beliefs
Yeah.
about certain things are certainly pervasive, and it'll be very interesting to see where they go from here. That's for sure. I, on that topic, I mean, I so bullish on the gold narrative, but I've I've heard you say before that gold it's less about the dollar depreciating against gold and it's more of gold trades as almost a pseudo currency against other currencies, but it sounds like you could be a little bullish on the dollar longer term or at least see a scenario.
Mhm.
But how do you think through the, gold versus dollar in your portfolio, especially if it's at negative rates?
If I recall correctly, the statistical correlation in changes in real dollar exchange rates versus real gold price changes in real gold prices, that over the period, 50 some odd years since 1968, the correlation in month to month changes in those two variables is something like 32, 33%. So two-thirds of the time, gold and the dollar may be rising together or falling together or not moving in opposite directions. So I look at gold as, yeah, gold trades against the currency market. If you believe in the dollar and you're bullish on the dollar, you move your assets into gold, the dollar. If you are bearish on the dollar, but you're bullish on Europe, you move your money into euros. And when you look at the United States and Europe and Japan and other purveyors of convertible currencies, and you say, blech, then you buy gold and silver. You say, I'm just going to put some money over here in gold and silver until I have a view as to where it's going to go.
Yeah, that makes sense.
Or
It's all a relative game. So I am bullish on this gold narrative, and I like we talked before we started recording, but you had done a debate between some Bitcoin maximalists and some more gold bulls, and you said as a result of the conversation, one of the Bitcoin guys said, "Hey, I think this gold thing actually makes sense." So I'd be curious of your thought of Bitcoin as a potential gold alternative, albeit highly speculative, higher beta play. But just curious your thoughts on Bitcoin overall as an investment.
oh, before I talk about my thoughts, my clients buy gold assets, silver assets, and they hold them. They Some of them trade cryptocurrencies, but they tend to go home flat. Yeah, it's a speculative type of thing. And on a short-term basis, Bitcoin's at 30 or $40,000. That's like buying Tesla at its current price. Tesla's current PE ratio is difficult to calculate because it hasn't had earnings for but a couple quarters. But it's like 2,700. So to buy Tesla at current prices, you have to believe that you're going to hold this for 2,700 years. uh, Buying Tesla at these levels is speculative play. You're following the parabolic move, and the same is true for Bitcoin. But that's on a short-term basis. On a longer-term basis, I think cryptocurrencies are the antithesis of gold. Gold is a tangible asset which is nobody else's liability. You own it, you can hold it, you can have it stored wherever you want, either in your control or in the control of somebody that you trust. Um, and it is geologically finite. I mean, there's an enormous amount of gold out there, and there's an enormous amount of gold that's refined and above ground. But there is a geological finiteness to gold supply. Actually, probably pretty much meaningless, but because people think it's important, we'll say it. National currencies, gold's value is based on the faith in gold. In 1999, 2000, when Clinton was running $320 billion surpluses, and the dollar was skyrocketing, gold was $270 an ounce. Now it's $1,800. Yeah, it's the faith in gold that determines the value of gold. National currencies, it's the full faith and credit of the national government that's doing it. They say, no, we will be responsible in supplying currencies, but they can increase it willy-nilly at their whim, at their discretion. So it's infinite. It's kind of meaningless. It's a piece of paper. And it's somebody else's liability. Cryptocurrencies have actually, they are somebody else's liability, but you don't know who they are. Right? And they say, oh no, it's a finite limit. We have these rules in place that we won't increase it over a certain amount. But those are the same rules that you built, that governments build for their national currency. And you can, with a couple clicks on your keyboard, change the amount of cryptocurrencies that you want. They say, oh, well, we wouldn't do that. Well, governments used to say that about their money too. And in the 1860s, when we didn't have a central bank in the United States, in the 1800s, it was up to individual banks. You would give them your gold and silver to store, and they would write notes, bank notes, based on the fact that they had that. And then they realized, oh my God, there are no federal auditors, and the state auditors are all drunk or crooked. So I can write as many banknotes as I want. And you had bank run and bank panic and bank scandal after bank scandal. The best book on the US monetary system in the 1800s is called A Nation of Counterfeiters. And the counterfeiters were the bankers, because they could just print money willy-nilly. And cryptocurrencies are sort of like that. They have an infinite amount. They're based on the faith in an anonymous entity that's created them. And they say, oh, well, we created it, but now it's off in the ionosphere and we have no control over it. But they do. They do have control because they have the code. And they can create more anytime they want. So they're not infinite. They have infinite supply. They're not finite supply. They are somebody else's liability. You just don't know who they are. And it's based on the faith of an anonymous person. So I see cryptocurrencies sort of as the antithesis of gold. Now, I do think that cryptocurrencies as a concept are here to stay. But I think that if you fast forward 10 years or so, the cryptocurrencies that we'll use will be national currencies that have gone crypto.
Yeah, and there's actually been tremendous headway so far at towards the end of Q4 2020 and January 2021 of regulations paving the way for these stable coins backed by the dollar to be used and held by banks, and all of these things that are actually moving quite a bit of adoption. So I would definitely argue. It sounds like the main argument is that the rules can be changed regarding supply. And I told you I wouldn't debate this too much, but and that's fine. So the argument there is that there's so many people looking at this that it's you can't tamper with it because of the network that's validating this and the amount of investment on it. But it made me start thinking of something that Jim Rogers always says is that the main lesson to learn from history is that we don't learn from history. And just coming up with, people fiddle with the supply to make money, is that perhaps instead of adjusting the supply of something like Bitcoin that everybody's watching, that everybody trusts, and the longer this thing goes on, the more that it's trusted that it won't be changed, is that if they're fiddling with the supply of something else, say one of these stable coins, and using that to pump up the price of the finite supply one, Bitcoin, then this could be a kind of smoke and mirrors, pump fake way of no, we're not adjusting the supply. Look, it's fixed. And look at the birdie kind of thing. Because history has a way of repeating itself. That's for sure.
Yeah, for every 1,000 people who are sitting at their computers trying to legitimately trade cryptocurrencies, there are probably 100,000 people trying to figure out how to game it,
Oh yeah.
and they mostly speak Russian.
It's a large bounty at this point, and it gets bigger and bigger every day, and there's more and more buy-in. So I'm bullish on it. I see it as a more speculative play on gold. I do see similarities to something like gold because of the fixed supply and stock to flow and algorithmic distribution of new coins and things like that. But it certainly has had a heck of a run these last couple of months, and it's making me rethink, position sizing in a portfolio. That's for sure.
So did tech stocks in 1999, 2000, and collateralized mortgage obligations in 2006. Uh, we had a guy who contacted us and hired us. He had sold a company he had inherited for $300 million. Really nice guy. And so he had a major brokerage house that managed the sale. And he got like more than $300 million. And they said, okay, well, now we'll help you manage your $300 million. And he said, okay, I want to buy $10 million in gold and platinum. And this was during the tech boom. And they said, well, we have this new tech fund. And he said, I don't understand that stuff. I don't want to understand it. But okay, I'll take $10 million. A year later, we get a call from his lawyer. And he said, the guy bought $10 million of gold and platinum, and he left it with the dealer. And now he wants it physically hit. He wants it physically, and the dealer's not giving it to him. Yeah. So we knew the dealer, and we said, pay us our fee. And we called the dealer and said, you got to cough up the money, the metal. And they did in 5 days. Yeah. And it was, as we were talking, now what about the $10 million he put into the tech stock? It's worth $1 million now. And I said, okay, so he still has the $200 million, $300 million that he didn't invest. It's just sitting there earning interest. He said, yeah.
Well, I mean, that's diversification, right? And you put a small piece into some of these higher beta, higher risk speculative plays, and sometimes they go even worse than down 90%. That's for sure.
Mm-hmm.
We're jutting up against the time, but I would be curious. I mean, we talked quite a bit about having a better understanding of financial markets, bubbles, gold, banking. I'd be curious if you have any books or articles that you could point my readers to have a better understanding. And I know those are kind of pieced all over, so I'll give you those categories. And if you have anyone that sticks out, please let us know.
I don't know anything off the top of the head. Obviously, for precious metals, it's CPM Group's Gold Yearbook, Silver Yearbook, Platinum Yearbook. Those are the best introductory books on it. I wrote a book called Commodities Rising in 2005 that it's dated, but it's basically a primer on commodities investing. And in terms of money and banking, I don't know of anything off the top of my head. I'm just looking at my bookshelf because there are some books that Exorbitant Privilege, which was a book written on currency markets maybe a decade ago. That's a really good book on the history of gold. Because you talk about beliefs and stuff. People talk about the good old days. They don't realize that in the 1950s, 1960s, up until 1971, there was one currency crisis after another. And we got off of the Bretton Woods dollar gold standard simply because it was so painful to all these different governments. Yeah. And they think, well, we had a stable economy during the gold standard. No, we didn't. We had a much more volatile economy during that gold standard day. And we had to be constant currency crisis. And the currencies didn't float every day. They were fixed until such point as they would be bankrupting a government. And then there'd be this abrupt assessment. So exorbitant privilege is a good one. But, I would say part of the problem in America and the world today is people read for confirmation is, and they've got to get away from that. And, buying basic textbooks, going to the community college and taking money in banking 101, looking for unbiased sources of basic information. I talk about the four sins of the intellect, ignorance, just not knowing stuff. I guess stupidity, the inability to think critically, to say that doesn't make sense, and then delusion, being deluded by others, and then self-delusion. There's a thing called the Ignatian presumption. Saint Ignatius, who created the Jesuits, came up and he said, if you want to debate something with somebody who doesn't believe what you believe, you have to understand, presuppose that they have a legitimate, honest, good reason for believing what they believe, and get to know what drives their belief system and their thinking, and then you can have a conversation. And you might be. I think it was Karl Popper who took and wrote a critique of Bertrand Russell's philosophy. And when he wrote it, like the first third of it was, this is what Bertrand Russell's philosophy is, and this is why he's wrong. And it was a fabulous paper, and Bertrand Russell's reaction was, I want to get the right to reproduce the first third, because he was much more succinct and to the point than I've ever been in explaining my belief system. I think you got to move away from reading for confirmation, and you have to start reading for comprehension. And you have to stop saying, oh, well, I'm going to watch the news here because it reaffirms my view. I'm going to read the news here.
Even though it might be a little uncomfortable and something that conflicts with your beliefs, right? Yeah. Awesome. Yeah. Really, really good advice. I actually like that. And exorbitant privilege, I haven't checked that one out. So I'll definitely link all of those things in the show notes. But Jeff, it's been a real pleasure. I really enjoyed this conversation. Many thanks for coming on. Where do you want to leave my listeners? Where can they find out more about you or CPM Group?
Well, they can find out about me at CPM Group at cpmgroup.com. There's some free reads, and there's some videos that we're doing these days. And there's information on some of the books and reports that we do. They can send information to info@cpmgroup.com and say, this is who we are, and we'd like to talk to CPM Group about what you do and what you might do for us. And I want to thank you for having me on. It's been very enjoyable. Unfortunately, I didn't get to come to LA and sit with you on the beach to do this. It's 35 degrees here in New York, but c'est la vie.
Well, next one, we'll do one in person. Masks, shields, big plexiglass in between. Something really comfortable like that. Jeff, right. It's been a pleasure. Thank you so much.
You're welcome.
There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.